There is a very strange phenomenon unfolding in the market right now. Companies are reporting fantastic news, the kind of news that should send a stock soaring, but instead, they're being met with a wall of selling. So today, we are going to break down this great disconnect and what it really means for you as an investor. This quote just hits the nail on the head, doesn't it? The game has changed. The main goal is shifting away from chasing maximum gains and toward the disciplined act of survival. It feels like traditional market logic has been completely thrown out the window, making capital preservation the new prime directive. All right, let's dive into the heart of the problem. What looks like pure market irrationality. We're witnessing a system where solid, fundamental performance is being punished by intense, indiscriminate selling that doesn't seem to care which company it's hitting. I mean, just look at Apple. The company reported absolutely outstanding iPhone sales. Historically, that's the kind of news that would guarantee a rally, but instead, the stock fell. So what does that tell you? It tells you this sell-off isn't about individual company performance. It's something much, much bigger. And this punishing dynamic, it gets even more extreme when we look at the hyper-growth sector. Here, fundamentally solid companies are being treated as the market's favorite punching bag, with valuations that seem completely disconnected from their actual operational success. Let's analyze the case of SoFi. By every important metric, this company is executing its plan flawlessly. You're looking at a 34% EBITDA margin, growth humming along in the 30% range, and a user base that has now swelled to an impressive 13 million. This is a company firing on all cylinders. So after that fantastic earnings report, the stock did exactly what you'd expect. It popped. But then the sellers came in with overwhelming force. They didn't just erase the initial gains. They slammed the stock down 11% from its peak. This is a perfect example of that profound disconnect. Next up, let's consider HIMS. Now, this is a company built on a resilient subscription model. We're talking over 90% recurring revenue. They're executing a very smart growth strategy, investing in their future, and all the while, their customers are sticking around. And yet, on a day with literally zero company-specific news, the stock was punished with a double-digit drop. The market essentially looked at their strategic investment in future growth and treated it not as a strength, but as a liability. This is fundamentally backward logic. So all of this leads us to question the popular explanations that are being passed around for this behavior. There are a few dominant narratives out there trying to justify the sell-off, and it's time we put them under the microscope to see if they actually hold up.
If this isn't about the performance of individual companies, then what is it about? Some other force has to be at play here. We need to identify the bigger, external factor that's causing this widespread and, frankly, irrational market reaction. One prominent theory you'll hear is that the market is afraid of a new hawkish Federal Reserve chair. The problem is, when you actually look at the likely candidate, Kevin Warsh, his public record is the complete opposite of hawkish. He's pro-innovation, he's spoken favorably about Bitcoin, and he has historically been in favor of rate cuts. The narrative just crumbles under basic fact-checking.
Another common explanation is fear of a government shutdown. But the irony here is that if you look at the historical data, government shutdowns have often been bullish for the market. After the last shutdown in October, the market actually rallied for 10 straight days. So this theory is also completely unsupported by the evidence. This bizarre market behavior isn't just limited to stocks. We're also seeing it in the asset classes that have traditionally been seen as safe havens. In fact, the recent performance of gold and silver has been particularly revealing. So, on a day with high inflation data, you would logically expect traditional inflation hedges like gold and silver to perform well. They did the exact opposite. They collapsed in value. Meanwhile, Bitcoin, while not immune, showed incredible relative strength, declining far less. What this crash in precious metals really does is expose a severe structural weakness. There are far more paper claims to silver being traded than there is actual physical silver to back them up. For every single ounce of real silver, there are 356 paper claims. It is an incredibly fragile system. And just to put the sheer scale of this into perspective, the amount of capital that was wiped off of gold's market cap in just 2 days was more than 4 times the entire market value of Bitcoin. This just demonstrates the immense risk that's actually embedded in these so-called safe assets.
So, given this environment of chaos and irrationality, the retail investor has to ask a critical question. How do you possibly navigate this market? The rules of the game have clearly changed, and that means your strategy has to adapt with it.
The number one priority is no longer to maximize your returns, but simply to stay in the game. And that requires a very disciplined approach. You avoid leverage through margin. You avoid the complexity and amplified risk of options. And above all else, you preserve your capital. Your primary job is to not get wiped out.
Now, it is absolutely critical to remember that this is an analysis for informational purposes only. It does not constitute financial advice. You are responsible for doing your own research. Do not trust this channel or any other social media influencer to make your financial decisions for you.
If you found this breakdown valuable, please click the like button and subscribe to Finbot Insights. It helps us continue to produce these deep dives into the forces that are truly moving the markets. Thank you for your time.